What's up guys, Adrian here. Welcome to another video. Today's video, I want to show you guys a few options you have as an alternative to cash savings accounts or granny type of investments like GICs here in Canada or CDs in the US. So I will go over three categories of ETFs that are typically safer and much more stable than the overall stock market. But my criteria is that they need to have at least a 5% yield or a 5% annual interest rate, right? So these places could be a great place to park some money for the short to medium term or used as an emergency fund. So I know many of you watching are older investors, retirees, or people about to retire, and not losing any of your hard-earned money is your top priority. So this video is also geared towards newer and more hesitant investors who desperately want consistent income but don't really like the craziness and the overall fluctuation of the stock market. So the reality is, guys, that we live in a very low interest rate environment. This is great if you want to borrow money, but horrible for conservative savers because the yields on cash savings accounts or super conservative investments as well as government bonds are at all-time lows and don't even come close to beating inflation. They're usually all less than 2% or even less than 1% now, which means they're completely useless, right? So in this video, I will review three categories of investments that are typically much safer than the overall stock market, but can give you a decent yield of 5% or more. So when I say yield, think of it like your annual interest rate, right? So the three categories I'm going to cover are preferred shares, corporate bonds, and alternative strategy ETF. So I'll give you my personal suggestions for the best ones in each category for both Canadians and Americans. So I'm going to cover the Canadian and the American stock market in this video. And then at the end, I'll give you my opinion on what I feel is the best option out of the three. So if you have any money sitting in your bank account doing nothing, or worse, under your mattress somewhere, or in some granny investment making less than 2% a year, or if you're saving up for a big purchase for the short to medium term and you want to park that money somewhere and actually get a bit of interest while you wait, this video is for you. Now, just an important disclaimer before we get into the funds, guys. Just because they are safer does not mean that it's impossible that the prices or the stock prices of these funds or ETFs will go down, right? They are still subject to some fluctuations. They simply fluctuate less than stocks or the overall stock market. So if there is another stock market crash like we had in 2020 because of COVID-19 or 2008, which was the financial crisis, these funds will still go down in value, just not as much as the overall stock market. So if you want something that will never ever move and gives a decent yield of about 5%, no such thing exists. In my opinion, I much rather get 5% yield with lower risk than make 1% with zero risk, right? So I just cannot stomach getting 1 or 2% yield on my money. It literally makes me sick and makes my stomach turn. But hey, that's just me. If you're okay with making 1% with your money, it's your money, so you could do whatever you want. So let's start with preferred shares, the first category. So what are preferred shares anyways? Well, they are the shares of a company with dividends that are paid out to shareholders before the common stock dividends are issued, or before the regular common shares get their dividends, right? So if the company enters bankruptcy, for example, the preferred shareholders or the shareholders that hold the preferred shares are entitled to get paid from the company's assets before the common stockholders or the regular shares. So they have preferential treatment, right? Just like the name says. So think of them like a hybrid investment, somewhere in between fixed income and dividend stock. So they literally have the priority over the regular dividend stock shareholders if the company is in trouble, right? So they tend to be more stable than regular shares of the company and have really more of a fixed dividend, but it's usually lower as well. So what are the best funds to invest in, or the best ETFs for preferred shares? Well, let's check out a few options together for both Canadian stock market and the US stock market as well. All right, guys, so let's start with options on the Canadian stock market. So I'm going to show you three options. The first place I always go to when I'm looking for a particular ETF, I always go to the BMO ETFs first. BMO is one of the big 6 Canadian banks, and in my opinion, they have the best lineup of ETFs in Canada. So they do have some ETFs here that deal with preferred shares. So I'm on their website right now, and as you could see, there's a couple of options here. So basically you have 2 options. You have ZPR, that's the stock symbol. So this is called the BMO Laddered Preferred Share Index ETF. This is probably one of the most popular ones in Canada in terms of Canadian preferred shares. Okay, so the dividend yield right now is about 4.76, so it's actually doesn't meet, or it's just under my 5% criteria here. But I'll show you another option for Canadian stocks when it comes to preferred shares in a little bit. I just want to cover the other option that they have, or the other fund, which deals with preferred shares with companies on the US stock market. So it's the BMO US Preferred Share Index. So keep in mind that these funds, ZUP here, ZPR, even though this fund here, ZUP, deals with US preferred shares, this fund is still listed on the Canadian stock market. So as you can see here, the yield is 5.16. So it's a little bit better, it's a little bit higher. No surprise, right? The US market is always a little bit higher in yield than the Canadian market. So you have here 5.16. They also have a version which deals with it's the same fund, but it's US currency, so we could skip that one. But they also have ZHP, which is the exact same thing, except it's hedged to Canadian dollars. So it's the exact same fund, BMO US Preferred, except it's hedged to Canadian dollars, which means that any currency fluctuations between the US and Canadian, the currencies between us won't impact the fund or the price of the fund whatsoever. So if you're trying to decide whether to get a fund that's hedged or the non-hedged version of the same fund, personally, I don't break my head with this. Just go for the one that has the highest yield, right? So the hedged one actually has 5.33%. The non-hedged has 5.16. So I would just go with ZHP as an option to invest in the preferred shares on the US market. Keep in mind, once again, these are Canadian listed funds. So here are the options from BMO that I would consider, guys. The only one that seems interesting to me because it's over 5% would probably be the BMO US Preferred Share Index Fund. So either ZUP or ZHP. And in this case, because ZHP has a slightly higher yield, that's the one I would go with. Now, for Canadian preferred share stocks, like we saw here, you only get a 4.76% yield. So I just want to give you another option specifically for Canadian preferred shares. And the option that I personally would go with after looking into it is probably the preferred shares of a very, very big split share fund in Canada, Dividend 15 Split Corp. So the stock symbol, don't forget split shares, right? There's 2 classes of shares, the preferred shares and the class A shares. So in this video where we're talking about safety, I think that dfn.pr.a is actually a very good way to get some, preferred share exposure in the Canadian stock market. So you're literally getting, some of the best companies in Canada. You actually have the core holdings of this fund. So we're talking about the best of the best here, guys. The top banks, the top insurance companies, top energy companies, and communication companies. You see them here. And with this dfn.pr.a fund, you actually get a really solid yield of 5.38%, which beats the ZPR at 4.76. So another advantage that the dfn.pr.a has is that fund, or the price of that fund, usually stays the same forever. It really only stays at about $10. It doesn't move from $10. So it's very, very, very stable. Just one thing to keep in note, that even though it's called Dividend 15, the preferred shares, you're not actually investing in preferred shares. Technically, you're still investing in the common stock of the best companies in Canada, but you're just getting them in a very, very safe manner. So I just want to point that out. Now, in terms of an option on the US stock market, it's pretty simple. This is the best fund that I found. It has to be the best one. So keep in mind, guys, this is on the US stock market. The fund is from Global X, which also manages QYLD. It's called the Super Income Preferred ETF. So the stock symbol is SPFF. If I was in an American and I wanted safety, this is the ETF I would invest in. It literally invests in, like it says here, 50 of the highest yielding preferred stocks in North America. So it has mostly US, but it also has a little bit of Canada. It has consistent income, and the yield is between 5.5% and 6%. So the yield is really, really good. And if you could, check out the distribution calendar, and it's a monthly dividend that hasn't changed in a really, really long time. So solid 5.5% here with SPFF. This would be my number one choice for you Americans watching, or anyone who invests on the US stock market. All right, guys, the second category of safer investments that give at least 5% yield are corporate bonds. So corporate bonds are literally debt issued by a company. They do this to raise money for their business and pay interest, and basically pay interest on the money they borrow, right? So buying corporate bonds is like lending the company money and making interest on that money. So same as government bonds, but because it's a corporation and not the government, the yield is a little higher than what the government bonds provide, because people tend to have a little bit more faith in the big governments around the world than corporations, which I think should be the inverse. But anyway, let's not get into that. So obviously, the bigger and more reliable the company is, the safer the investment will be, right? So in this case, I'm only talking about, big blue chip corporate bonds. I'm only talking about safe stuff here. So there's a few interesting funds out there that don't use any leverage that Canadians could buy. So let's check out my top pick for this one here. Unfortunately, I'm unaware of any US listed funds that deals exclusively with corporate bonds and that does not use leverage. So there's a lot of them in the US, but I only found most of them that use leverage. So because we want safety here, I want to make sure that everything we deal with is not leveraged at all. So I will exclude them from this list. So let's check out the best option, in my opinion, for Canadians in terms of corporate bonds. So back to the BMO ETFs list, guys. Once again, in my opinion, they have the best ETF when it comes to corporate bonds. So the fund that I want to show you guys is the BMO High Yield US Corporate Bond. So you have, once again, a hedged version and a non-hedged version. So ZHY or ZJK. So in this case, the non-hedged version, so the regular version here, ZJK, has a slightly higher yield, 5.52 over the hedged one at 5.49. But either way, they're pretty much neck and neck, right? You're looking at about 5.5% yield, guys, off corporate bonds. These are, however, US corporate bonds. So we're talking about companies on, US companies, Johnson & Johnson, Bank of America, Pfizer, etc., etc. So very, very, very safe. BMO actually gave this fund a low to medium rating. We could just check that out real quick here. So so here it is, low to medium rating. So if we actually even check out the chart, this is the maximum chart here. So this fund, let's see, was 2017. So it's about four and a half years this fund has been out. And as you could see, the price of the fund is really, really stable at about $19, $20. You could see here the COVID-19 crash. It actually went from 20 only to about, 17, 18, and then now it's back at mid 19. So this is over a course of 5 years. So as you could see, very, very, very stable share price, guys, and you're getting a solid 5.5% with ZJK. Once again, the BMO High Yield US Corporate Bond Index from BMO. This is probably the best option for us Canadians in terms of safety, in terms of corporate bonds, because you're still getting a nice 5.5% yield. All right, guys, so the third and last category of safety ETFs that I want to talk about are alternative strategy ETFs. So as you probably guessed, these would be my favorite in terms of safety and yield. They have great consistent income and are much less volatile than the overall stock market. And I have some great options for you, some options even that are much higher than 5%. So I tell you what I think are the best ones for us Canadians, and I also have one option for my American friends, or if you're investing on the US stock market. So let's check them out. All right, so back on the BMO ETFs list. In my opinion, BMO has one of the best alternative strategy ETF for safety and income, and I'm talking about the BMO US Put Right ETF. So the stock symbol is ZPW. And there's also a hedged version, ZPH. So as you can see, they're about this almost the same yield. And we're talking way over 5 here, guys. So 7.06 and 7.18. So if you're a longtime follower of my channel and you've seen my portfolio unveils, you know that ZPH is what I hold or what I use in terms of safety. And I kind of think of it like my little cash savings account. So I'm making 7% on this. So what is a put right ETF, right? What does that mean? Well, if we actually click on ZPW here and bring up the page, so a put right ETF is basically an ETF that uses an options trading strategy, just like a covered call option strategy, but it's the opposite. It's a put right strategy. So I just want to show you guys here that first of all, the risk is also low to medium with this one. And if we actually look at what this fund holds, you will see that it doesn't hold much of anything, and that's the point. So this is why these put option ETFs are very safe, because they typically don't hold much stocks at all. They only hold stocks temporarily because the fund manager was forced to buy them. So in this case, it's no different. These are the stocks that they wrote put options on, which are, instead of covered call options, which are options to sell the stock to someone else, you're selling an option to buy a stock off someone else, right? So these are the stocks here that they ended up getting stuck with, if you want to say in quotes, right? So if you actually scroll down to the bottom, you can see that the majority of this fund is in cash. This is what I'm talking about. It doesn't hold much of anything. It writes put options, and you could actually see the put options in the holdings, which is pretty interesting. So this should give you a really good idea of how put options work. Let's go through a quick example together, okay? So as you could see here, they've sold a put option on Facebook shares, and you could see the date, and here's the key: $340 put option. So right now the Facebook's share price is about $360, $365. So when you sell a put option at 340, you're basically saying to another, or the person that you've sold it to, who paid you a premium for the option, by the way, this is how this fund makes money, that if ever the Facebook share price goes down to $340, I will buy the shares off of you. So that is the right, or that is the contract that you're selling to a seller, so to a buyer, sorry. So you're essentially selling somebody downside protection, right? Because let's say if Facebook goes to $340, well, you're gonna buy the Facebook shares off of someone. So for that other person, they literally bought downside protection off of you. So if Facebook within 30 days or 60 days, whenever the option contract is, stays above $340, well, this option expires worthless, which means you don't have to buy the shares off of him, and you get to keep that premium that he paid you. So this is what put option ETFs do. They basically sell downside protection. And if you want to read up on it, I know it's a little bit confusing. It took me some time to figure it out, but once it clicks. It's really easy. Check out this ETF here, and if you want, go at the bottom and just click on this document here, Put Right Strategy, and it will tell you exactly how the put strategy works. But needless to say, this is managed by a professional, guys, BMO. So they're gonna sell just enough to make about 7% and make the fund nice and stable. The stock price stays nice and stable. So are there any other Canadian listed funds that are very similar to this? Yes, there is. There's actually one from Purpose Investments called the Purpose Enhanced Premium Yield Fund. So it does the exact same thing. It sells put options, and it has a yield of about 7%. The only thing I don't like about this fund, and why I haven't invested in it, is because it's a very small fund. So there's not much trading activity, so it might not be a very liquid fund. And going back to BMO now, I would be amiss if I wouldn't show you another option that they recently came out with. So it's ZPay. right? So this is another alternative strategy, you could say ETF, but ZPay, unlike ZPW, first of all, the yield is a bit lower at 6%, and just like the other one, you have a hedged option. ZPay.F is the hedged one. ZPay is just a regular one. As you could see, they're almost the same in yield, but ZPay is a little different than ZPW because it does put options and covered call options. So it does a little bit of a combination of both. So it actually, if you actually go in the holdings, I just want to make sure you understand here, it's a low to medium risk as well. So if you actually go in the holdings, it does hold a little bit of stocks long term, and it holds mostly very, very solid American blue chips. So MasterCard, Amgen, Merck, Intel, Facebook, Microsoft. So very, very solid companies. And they also, on top of the put options, you could see some here, they also sell a call options. Here's one right here, call option. Wow, lots of puts, not many calls. Oh, here's another call. So they do a combination of both put options and covered call options. So so that's basically it. So it does a combination of the two, except the yield is slightly lower than ZPW. So what about for my American friends? Well, for my American friends, I got great news for you. You probably have one of the best ones ever. It's the NUSI. So this ETF, the stock symbol is NUSI. It's the nationwide risk managed income ETF. So just the name says it all, guys. Risk managed income ETF. So what this basically does, it's not exactly, it is an options straight trading strategy as well, just like the other one, but it's a little bit different. So this one, first of all, the yield is really, really good. It's in the high sevens, which is really good. And basically what this does is it invests in the NASDAQ 100 and it sells covered call options. That's how they make the income generation, right? So there, as you could see here, covered calls, but they also write a protective put option on the fund. So you have income and downside protection. This is what brings, this protective put is what brings stability to the fund. So a really easy way to think of this ETF, guys, it's basically QYLD. It does the same, it invests in the same thing as QYLD. It's a NASDAQ 100 index, but it has a bigger level of safety because of the protective put. But of course, it doesn't have the yield that QYLD. QYLD has 10, 11, 12% yield. This one has 7.5% yield, but it's very, very stable. If you actually look at the stock price, you will see what I'm talking about. So if you're interested in the NUSI, my opinion, the best one on the US stock market, go on the website, guys, and they actually have a video that explains how this ETF works. So make sure to check it out. So in short, guys, these are the best alternative strategy ETFs. NUSI on the US stock market is the best one, and ZPW on the Canadian stock market, the BMO US put right ETF. ZPH is the hedged version of this, and that's what I personally use. So there you have it, guys, some safety ETFs for you, whether you're Canadian or you're American or outside of North America, investing on the American stock market. So for me personally, I really like the alternative strategy ETFs, which use various options trading strategies to get you some nice income with relative stability. Personally, like I mentioned, I use ZPH, and if I was American, I would definitely use the NUSI, NUSI. So one exercise you guys could do on your own to compare all the options I gave you is check out the stock price for each fund and look at what happened with the stock price during the 2020 COVID-19 crash, because that's basically worst case scenario. So we actually have the privilege, because a crash just happened, to see how these stocks or how these funds behave during a stock market crash. And as you will see, it's really not that scary. Some of them went down, 15%, some of them went down 20, 25%, but after a matter of weeks, just like the overall stock market, they recovered and now they're super, super stable. So the graphs look something like this, then it goes down, a big V, and now it's very, very stable. So very, very safe funds, guys, but it's up to you to really decide which one is the best fit for you. Everyone is different. Everyone thinks of risk differently. But fear tends to go away with time, guys. So if you're a newer investor, keep that in mind. But if you have money sitting around making less than 1%, you are disrespecting money, in my opinion, and it makes me quite sad. So please don't do it. Use the ETFs that I provided you and that I've shown you. This is the way I see it, guys. The longer you hold an investment and the longer you're making income off of it, the safer it becomes, because you're literally paying off your initial investment with the income that you get month after month. This is why I'm a buy and hold investor who doesn't care much about stock prices or what the overall stock market does. So if I don't intend to sell anything, why would I care about price fluctuations or the overall fluctuations of the stock market? It doesn't really make sense, right? Because it makes no difference. The only thing that matters to me is that consistent income, which is what these funds were designed to do. What a great time to be alive and invest, right? So every month that goes by, the less I care, the less we're going to care, because the more income we're going to make. So it's as simple as that. So I hope you learned something from this video, guys. Please show your appreciation. Hit that like button. It takes less than half a second. And it's free for you. It helps the channel grow, so I would really appreciate it. Don't forget to check out our website, passiveincomeinvesting.ca. That's where you could pick up my digital product, which I'm selling for only $45, which is all my years of research into all the best funds that you ever need to build your own portfolio in Canada or in the US. It includes all the funds that I talked about. It also has sample portfolios for Canadians and Americans. Really, really good product. I keep getting amazing reviews and feedback on it. I really appreciate it. So I really know it helps. I still use it myself as a reference tool. So it's pretty good, and I put a lot of time into it. And the good news is that I'm working on version 3, the next version, and you just need to purchase it once no matter what, because it comes with lifetime updates. Also on my website, I offer a one-on-one consultation service. If ever you want my help, you want to talk to me, answer all your questions, help you transition or build a new portfolio, whatever it is. I do about 4 to 5 a week, and I love doing them. But I'm really full. My schedule has been booked up until October, so I'll let you guys know when the October appointments are open. So be patient with that. I appreciate the patience. And of course, guys, don't forget to make sure you're subscribed so you don't miss out on my future content on passive income investing. It's all designed to help you guys. That's my goal. We're also on social media. Follow us on Instagram. We have a Facebook group that keeps growing. So we have a nice little community there. It's pretty cool. So all that info is in the video description below. Make sure to check it out. The mission of this channel, my mission, always be the same: to help everyday working regular people to invest on their own, to build their own source of passive income so they can enhance their quality of life. So with that, take care, guys. Stay safe. See you next time.